Hello and welcome to another episode of Be the Bank, where you'll learn how to create safe, reliable streams of income secured by real estate without the downsides of property management. My name's Robert Heitha. I've been working in this industry full-time since 2011. I've helped my clients buy and sell over 1,000 assets, and I want to help you do the same. So before we get into the show here, I want to thank our 21 new NDA non-disclosure agreement signers for getting on the list to see upcoming asset opportunities for sale. And I want to thank our 5 new mastermind members, bringing our group up to 47 investors working together to help each other succeed. So without further ado, let's get into the show. Okay, so on episode 30, we are starting with free resources for note investors. I want to give you guys the best information to get started in this business. We're talking the overview of the industry at a high level, where to start passively versus actively investing in mortgage notes. Then we're going to talk about the tech that enables us to work this business from anywhere in the world, asset acquisition opportunities. I'll show you how to get on the list to see future opportunities for sale. Then we'll go over 2 case studies. And then finally, if you stick around to the end, I'll show you how to go on a free consultation call with me. Today, we've got our little friend, David Rose, sniffing around, hanging out. And we've also, of course, got our birds, which I'm not really angling right, but we've got some birds out there. Hopefully it's a sunny yet snowy day. I took that drone footage at the top of the show just 2 days ago. It was pouring snow. We're totally coated here outside of Philadelphia. Okay, so let's get right into the program here. Start bringing down the music. If that was too loud, I apologize. FIXnotes.com/learn, the best online course to learn this business. It's all free. How to invest in mortgage notes, organized into a bunch of different modules, from everything from the due diligence and acquisition process to management and dispositions of your mortgage note assets. So definitely check that out for free, 100% free, all available on the FIXnotes website. We also aggregate on FIXnotes.com/news information from around the industry, timely, relevant, important, actionable information for you to understand as a note investor. And then we've got FIXnotes.com/terms. And this is where we share the lingo, the behind the scenes knowledge that you need when you start communicating with others in this space. So definitely check out all those free resources over at FIXnotes.com. So let's get into the show here with the industry overview, communicating to you how you can get started in this industry in a passive capacity all the way up to a more active position. So we'll look at that chart now. So let me actually switch to this screen here. So going from passive to active, we've got a couple different ways that we can get into this space. For starters, we're talking less than 10% returns, or maybe around 10% on the passive side, all the way up to 50% plus returns investing in mortgage notes actively. So the first thing we have on the passive side is a mortgage note fund. You can invest in mortgage notes secured by a diversified portfolio if you work with a fund provider. There's a bunch of these out there: PPR, Aspen Funds. The company I work for, US Mortgage Resolution, previously had some offerings. I don't think we're raising any capital in this space now. And then others like AHP, who offer crowdfunding in mortgage notes. So that's a more passive approach to mortgage note investing. Now, as you move towards active, we've got equity partnerships with private investors. So this is another way that's a little bit more personal, a little bit more a la carte and customized to your specific situation and the partners that you're working with. But it's also a great way to invest in notes where you're putting up the capital and another more experienced investor is doing the work. Now, if you're coming to this show thinking in terms of passive note investments and you're working on vetting your counterparties here, I'd be happy to help. So stick around to the end of the show. You'll learn how you can get on a free consultation call with me, and I'll let you know what I think of a mortgage note fund or an equity partnership that you're currently contemplating. Now, if we keep going, let's check on our boy. I think he's gotten a hold of the GoPro here. So as we move down towards more active options here, we've got partial acquisitions of cash flowing reperforming loans. So if you actually buy individual reperforming loans, you can buy partial agreements on those assets, where an investor who's got a cash flowing loan can sell a piece of their payment string to you. Now, this is less active than the next one, which is buying cash flowing whole loans outright, because you've got an investor who's basically supporting you in that process. The investor who sells you a partial has a vested interest in maintaining that cash flow. So partial acquisitions of cash flowing loans are a great opportunity to invest in notes that's around right in the middle of the scale between passive and active. You still need to vet your counterparties, you still need to vet the actual asset that you're looking at, but it provides a little less work than if you're buying your own cash flowing whole loans outright. In that case, you got to do a lot more due diligence on the asset because the investor who you're buying it from isn't maintaining that vested interest through the partial process. Finally, we've got buying and working out non-performing loans. So this is the most active way and what we focus on in this show. Buying and working out non-performing loans gives you the highest returns, but it also is the most amount of work. But that's how we're going to frame the rest of our conversation around buying and working out non-performing loans. So let's zoom in on that and start with the non-performing waterfall evaluation. So this is a great way to visualize the due diligence process when you're thinking in terms of buying a non-performing mortgage note. We start at the top with secured versus unsecured, and that essentially means your ability as a lender to foreclose and to have some collateral supporting your investment. So as note investors, we look for secured notes because we're real estate investors at heart. We want to be secured by hard assets. So last week we talked about secured versus unsecured, and I'll show you that slide briefly here, but if you want to see more, go to our last episode, episode number 29. Next on the list, though, is first versus second liens, and that's what we're going to get into today, the differences between first and seconds and why I prefer second liens. So right off the bat, secured versus unsecured. Really, secured means the property owner equals the borrower. Now, there's some caveats there, which we got into in more detail on our episode 29. So we're not going to go through this entirely, but I wanted to put this up on the screen just so that you're able to get a snapshot and understand exactly what we're talking about here. With methods for determining property ownership and understanding the false positives and the false negatives that are possible when doing that research. Okay, so let's move on to the topic for today's due diligence analysis, and that's junior versus senior liens. So junior versus senior is an interesting question that's a predominant question in the marketplace where some investors really prefer seniors, others prefer juniors. Seniors are typically higher due diligence expenses. They can still be wiped out by taxes or homeowners association in super lien states. There's more property-centric resolutions in senior liens. You also need to make sure to have forced place insurance in place if there's no property insurance currently being paid for. They're more expensive and lower quality collateral. Junior liens, on the other hand, the due diligence is a little bit less expensive, $50 to $200 versus $250 to $500. They can also be wiped by senior, taxes, or homeowners association. But the difference here is that since the senior lien can also be wiped by taxes, if you invest in a junior behind a senior that's current, you can be a lot more confident that those taxes are being paid. In junior liens, I see much more often borrower-centric resolutions that has a lot to do with emotional equity. And that supports investors who invest nationwide because you're not taking back as many properties around the country when you buy junior liens. And there's greater discounts in juniors, so you're able to diversify a lot more. So at the end of the day, I prefer seconds. They offer greater diversification, more autonomy, better protection, and a less expensive research process versus those senior liens, which you got to be more prepared for REO situations. There's higher capital requirements and a more involved portfolio monitoring process to make sure the property taxes are being paid. So that's why I believe smart money prefers junior liens in this space. All right, let's move on. We're going to talk about value in the next call, but for today, we're going to skip over the rest of these steps of the due diligence process. Save that for our next episode. All right, so let's talk about market pricing because that's very, very important to understand when you're actually bidding on non-performing or reperforming cash flowing assets in this business. So on the reperforming side, where we'll start with over here, we've got senior liens that are performing, they're cash flowing. We call it reperforming because these are higher yielding loans that were once in default but are now paying again. So on the senior lien side, you can expect to receive about a 7.5% to a 12.5% yield if you buy performing senior liens. And on junior liens, you can expect to receive a higher yield, 11 to 20% yields, or sometimes even higher depending on how perceivably risky that junior lien investment might be. Now, reperforming loans are always based on yield because when there is cash flow, just like a rental property, there's more certainty around what to expect in the deal. On non-performing loans, there's a little less certainty because there's no payments being received. Now, you do have certainty as a secured lien holder that eventually you'll get paid because you do have collateral supporting your investment, but we price it a different way. We price non-performing loans based on fair market value when they're in senior position, because like I said, first position senior liens typically resolve through the property more often. The fair market value of the property then is very, very important. We see pricing between 7 and 83% of the fair market value on first mortgages. On second mortgages, however, we price based on unpaid principal balance because more often than not, in junior liens, you are resolving the debt with the borrower, that underlying unpaid principal balance. Now, we saw a huge increase in non-performing second lien pricing in this last month. We just wrapped up an offering for FIXnotes for one of our larger clients selling both junior and senior liens, and we saw an unprecedented demand for non-performing junior liens. So we've actually increased the upper end of this range by 10% to 72% of the unpaid principal balance. Now, we actually saw some pricing even higher than that at 80% plus for non-performing junior liens. Now, these junior liens were cream of the crop here. They were behind performing seniors with equity. So they were very, very high quality juniors, but that's a higher price than I've ever seen before in second position loans on our most recent offering. So this is definitely something to consider when pricing, but it's very important to use your own due diligence when you're analyzing assets to determine the return expectations that you can expect to receive. So always price loans based on the final result that you expect. I like to price loans based on a potential foreclosure or a potential modification agreement or possibly a discounted payoff. And then comparing all of those different maximum allocated values and then coming up with a happy medium between the three, or 4 or 5 if you use some other potential exit strategies like short sales and deed in lieu of foreclosure as well. And of course, we get into all of that in the course and in previous and future episodes of this show. So stay tuned. So I wanted to actually give you a little bit more detail on the pricing that I'm seeing for non-performing junior liens as a percentage of UPB. So this chart is based on senior lien status and equity for junior position notes. So we've got some main categories here of senior lien status: current, semi-current, delinquent, unknown, or foreclosure initiated. And then within each of these senior lien statuses, we have 4 equity statuses: full equity, partial equity, no equity, or underwater. And these can be adjusted based on your own risk tolerances, but for my purposes, full equity is less than 100% CLTV. Partial equity is, I think, actually, I don't have the exact metric here, but it's less than full equity as far as the amount of coverage that you're protected by in your junior position. No equity, of course, it's well above 100% combined loan to value. And then underwater is even higher equity CLTV than that. So just looking at this at a high level, we're seeing between 30 and 65% when the senior is current based on these statuses. Now, there are other caveats here to speak of, but at a high level, this is a nice way to approach current senior liens with varying degrees of equity. Semi-current, delinquent, unknown, and then all the way down to foreclosure initiated at 5%, sometimes even less than 5% for foreclosure initiated, depending on how long the senior lien has until the foreclosure sale. And of course, how much equity is available to potentially earn the junior lien holder surplus funds if that foreclosure was completed. So this is like a snapshot of the marketplace. It's for an estimate for discussion purposes only, but I think it's a good place to start, and it does reflect the results of our most recent offering. However, I wanted to cap it at 65 because I was surprised how high pricing got. I don't think that pricing will continue to be so high in the 80s and 70s as a percentage of UPB. I think that it's a matter of investors chasing yields and just asset classes in general being inflated across every sector. So I do think that this is a short-lived blip. I think we'll go back down to that 65% range in the future with regards to non-performing second mortgages. Okay, so let's get on with the next slide here, which is just kind of giving you the high level as to what to understand when you're buying your first loan. So a LOI is a letter of intent. And before you submit a letter of intent to purchase a performing loan or a non-performing loan in first position or second position, you need to understand a couple of things and fulfill these requirements. So first off the bat, you need to have your purchase entity registered. You do not want to buy mortgage notes in your own name personally because you're going to be on title in that county where the property resides, and your name is going to be in the public record. So you want to protect yourself with a limited liability company or some other type of corporation that gives you that protection. Now, you'd also want to have about $50,000 available. A lot of sellers will request a proof of funds. So that $50,000, if you're thinking in terms of maybe a $30,000 minimum trade and $20,000 in reserves, will give you enough of that dry powder to be able to pay off property taxes, pay for an attorney if necessary, and do some of your collections work with funds in reserves to pay for it. You also need to have the time to commit to due diligence and closing. You never want to submit a letter of intent to a loan seller if you're not fully prepared to back that up if your offer is accepted. You need the time available to complete your due diligence and then get back to the seller with your final verdict on the loan, whether or not you're going to be buying it or whether your research uncovered something that makes that loan not viable for your investment. You also need to have a servicing contract in place. Now, this is one of the most important vendors that you work with as a note investor. Your loan servicer needs to be prepared to receive those assets to start servicing your accounts for you. Now, you could potentially keep the loans with the seller's loan servicer. That's called servicing retained versus servicing released. But not every seller allows that. Their current servicer might not be accepting new clients. So you need to prepare to have a loan servicer in place. And also a document custodian. If not yourself, you could have collateral files actually shipped to your own office so that you can manage your actual paperwork yourself, or you can use a document custodian like Richmond Monroe or Orion Group or many other document custodians that actually will hold your files for you. You do need to have a United States address. Mortgage notes are not typically shipped outside of the country. So although you may be an investor outside of the country, you want to make sure that your document custodian is in the United States. There's a couple other recommendations here. One is to complete the online note course. It's 100% free, so why would you not? Over at FIXnotes.com/learn. Also, I think it's really great to put in place an earn and learn service-based business, especially if you have lower capital available to deploy in the beginning. An earn and learn business, which I think I talked about in episode 15, is a great way to get into the business, to add value for other investors in the space, make connections, network with others, and then eventually parlay that opportunity into your own portfolio. So definitely something to consider if you have lower capital in the beginning of the process. And then finally, I'd highly recommend the Mastermind membership. We've got 47 members now, all working together to help support each other's businesses. And our next Mastermind call is March 3rd. So we'll have a recording if you sign up for the Mastermind after that. But if you want to get on the call live and ask questions, definitely be in the group before March 3rd. All right, so let's talk about that loan acquisition process once you actually buy a loan, once your letter of intent has been accepted and you're at the point to purchase the loan. So we're actually going to backtrack a little and go through the steps here. So first is to build the seller relationship. You want to call them, you want to make an impression. If you're just communicating via email, you can get some deals done, but in general, a seller is not going to work with somebody who they've never even talked to before. So make an impression, build some rapport. Do your pre-bid due diligence process. Before you submit your letter of intent, your indicative offer, you want to make sure you have a general idea of what kind of loan you're buying. Then once you submit your letter of intent, your proof of funds, you wait until an acceptance of that. And then once it's accepted by the seller, you move on to your due diligence process. Your final due diligence is going to consist of pulling title reports occasionally, running credit, checking AVMs, maybe doing a skip trace. There's a whole bunch that goes into that final due diligence process, which is going to make or break your decision whether or not to move forward. So you want to be very comprehensive with your review in this time. The seller is agreeing to some exclusivity to allow you to spend the money and the time to review those assets. If everything looks good, you need to move forward with the purchase. So you present those findings of due diligence to the seller. You maybe will do some negotiations. We call that a fade if perhaps the fair market value of the home is less than expected. So you finalize those negotiations, you finalize price, and then you execute the loan purchase sale agreement. The LPSA is the agreement between the buyer and the seller to transact a mortgage note. Once that's taken place, you're going to wire the funds to the seller or to an escrow company on the closing date. You'll provide your servicing transfer instructions and your collateral delivery instructions so the seller knows where to direct the loan servicing and where to send the physical files, the paperwork. Finally, you'll review and approve the seller prepared assignments of mortgage. That's the last step before the docs are actually shipped out, because they're going to have to prepare the transfer documents, an assignment of mortgage, which is recorded in title, showing everybody in the world who now owns your loan, and the allonge, which transfers and endorses the note. So there's four main documents: the note, the mortgage, the assignment, and the allonge. The allonge transfers the note, the assignment transfers the mortgage, and all of those documents need to be in place before they're shipped out to you. Once you receive those collateral files, either through your document custodian or at your own office, you'll need to review for all of those documents to make sure that everything is in place and is an enforceable mortgage note. Typically, you'll receive your files within a month of funding, and then you'll normally have 30, 60, 90 days, depending on your contract, to make sure all the docs are in place and to request anything that may be missing. Once everything is good to go, you've got your files, you need to send your assignment of mortgage plus a fee to the local county recorder to file that assignment of mortgage in public record. Now, some sellers may do this for you, but it's very important to understand this process, because if you do not record your assignment of mortgage, nobody knows you own the loan. If that property went to foreclosure sale and maybe there's surplus funds available above the first position mortgage note that was in foreclosure, the second lien, if you're buying a junior here, would receive surplus funds. But if they don't have the assignment of mortgage, they don't know where to send those proceeds. Or notices if the borrower went to the bankruptcy, or anything to do with that property. If your assignment's not recorded, you're invisible to the marketplace. So you need to record your assignment. All right, so let's just talk briefly about the servicing transfer process here, so you understand a little bit more about how to actually get loans into your servicer system. First, the seller is going to connect the loan servicer with your servicer, the new servicer. The current loan servicer is going to send a preliminary loan data to the new servicer so they can begin to board that data into their platform. RESPA letters and TILA letters are prepared and scheduled to ship. That's your Real Estate Settlement Procedures Act and your Truth in Lending Act letters, which are required in the transfer process. Next, there'll be a servicing transfer date that's normally set for about 15 days after those RESPA and TILA letters go out. It's called your RESPA hello and RESPA goodbye. My servicer sends a goodbye letter, your servicer sends a hello letter, assuming I'm the seller and you're the buyer, and that's what notifies the borrower that the transfer is being made. Then final loan data will be sent to your chosen servicer as of the transfer date. The servicing transfer is typically finalized about a month after funding a deal. And then from the transfer date on, new borrower payments are now going to your loan servicer, and the borrower has been notified of such. If any payments went to the old servicer, they'd be passed forward to the new servicer as it's now owned by the new lender who's servicing it with a new company. All right, so that's the servicing transfer process and high level how to buy loans. Let's talk about tech tips. This is an important part of this business. What makes it actually effective for us as 21st century entrepreneurs, the internet. So you need a capable PC or Mac, you need a decent smartphone, and you need a good internet connection. But using all these different tools, we're able to automate a lot of our business and do things in a more efficient way. So a whole bunch of services we use. Podio is a really great one for your CRM and database. And actually the mastermind group is built on Podio, so you can start to learn this platform as a mastermind member. Pacers, where we review bankruptcy records. Citrix Podio workflow automation, also called Globoflow, is how we automate Podio and connect it to various services like Right Signature, where we execute documents. I'm on Gmail all the time, maybe more than I should. I should maybe automate some of that Gmail, but so much of this business is through email, so you got to be comfortable with that. Zapier is another way to automate, similar to this Citrix Podio workflow automation, but it's easier to use and you don't need code. So I use Zapier to connect to Google Sheets and to some other services myself. Speaking of Google Sheets and Excel, this is really the engine that drives your business apart from Podio. Using spreadsheets is how we analyze and build our model to value mortgage notes, and it's also often how investors will track mortgage notes. For the first 5+ years of my business in this space, I was tracking a master inventory in Excel. I wasn't using a CRM like Podio, it was all in spreadsheets. Either Google Sheets or Excel. You can do a lot of your management right in a spreadsheet. DataTree is an awesome way to review property public records on kind of an a la carte one-off basis. CoreLogic is a great way to do so on a bulk analysis basis. ProTitle is how we run O&E or title reports. And then TransUnion is credit provider and TLO is a skip trace provider. And what we're gonna do now is actually zoom in on CoreLogic and TransUnion to talk about credit. as a junior lien investor, and that's kind of what we're focusing on today's episode, you really need to review the senior lien status on the credit report. So we're going to go over at a high level what this consists of, and then we're going to actually look at 2 credit reports or maybe 3 credit reports and put it actually into practice. So the first thing when you're looking at a credit report you need to understand are trade lines. Every single debt that the borrower owes is on your credit report as a trade line, and those trade lines have pay strings. So what a pay string essentially is a history of the payments that have been made on a specific trade line. So if you see all ones, that means that the borrower is paying as agreed, they're current. 12 ones means for the last 12 months, they've been paying on time every single month. Semi-current, we call it, is when the account is rolling late, rolling 30 or perhaps 60 days late. If you see all 2s, the borrower's making their payment every month. They've just been a month behind every single month. A 3, they've been 2 months behind, but they are making those payments. So we call that rolling 30 or rolling 60. And that would be a senior status of semi-current. Delinquent, however, is when it's 90 to 120 days or more late. And that's when you start to see something like this. Now, these payment strings are in reverse. So the first number on the list is the most recent month, and 12 months ago would be over here. So this example shows us that 12 months ago they were current in the next month, then they got behind, but they made their payment, they got current again, they got behind, and now look at this. They stopped paying right in this month, and 2, 3, 4, 5, they've now delinquent, and those 5s mean that they're past 120 days late. Now, foreclosure initiated is normally listed as a remark in the mortgage note trade line. However, when you see all 5s like this, they've been delinquent for over 12 months, you can be pretty sure that that file has initiated foreclosure, unless maybe, like today's market, there's a foreclosure moratorium, in which case it maybe has not been initiated yet. The only way to know here would be to look at public records to find a lis pendens or another evidence of a senior lien foreclosure. And then finally, foreclosure collateral sold, that would be listed in a remark, and that would mean the loan is no longer secured. You'll confirm that by checking the property owner on title to see if it matches the borrower that you have on your data tape, the spreadsheet of mortgage note data. So the main things you need to look for are balance, past due, payment amount, and reported date. Those are the main things that I'm going to add to a spreadsheet to track on my credit report review. A couple other tips here. Other things that you can find in the credit report: FICO factors, so that's the borrower's credit score; occupancy status, whether or not they're living in the subject property; employment details; public records, whether they filed bankruptcy or not; and then lifestyle and spending. You can get to know a borrower by looking at their credit report to see what they're prioritizing, whether they have car loans or casino debts. I've even seen all sorts of things that you can find out when you look at that credit report. So let's actually look at a real credit report here. I got a couple to look at. We'll start with a CoreLogic report, and this is an easy one because it's a current senior lien. So we're looking at this one because this is what you want to see as a second mortgage investor when you pull up a new borrower's credit report. So right off the bat, we can see there's 2 real estate trade lines, 2 mortgage notes on this. One is current, one is closed, and we can see the balance and the payment amount. We can see there's blanks here for 30, 60, 90, so they are current. That's very good to see. Some installment loans, some revolving loans, be credit card debt, and perhaps like an auto loan here. And we keep scrolling and we can see some FICO factors, why their credit score is only 685. Keep scrolling here, and now what we're doing is finding the trade line that reflects the senior mortgage loan. Like I said, with lifestyle, we can see a couple auto leases here. It's a Chrysler and a Hyundai, so not luxury vehicles, so that's probably a good thing to see. They are current on those loans. One of them is closed and one of them is still current and active. All ones, they're making their payments, and this one got paid all the way down to 0, so they've actually closed out. Full termination, obligation satisfied. All right, here we go. Now we're talking mortgage notes. We see a home equity loan and a real estate conventional loan, and you can see they both originated in 2007, one in April and one in July. So typically the senior lien is recorded before the junior lien. The first loan on title based on the date is the senior lien, unless a subordination agreement would be recorded to change the position of these. But that gets a little advanced. For now, we can assume that this is the first position mortgage. We have a couple ways we can understand that. One, the balance is a lot higher. First mortgages are often higher than juniors, but more importantly, it's the date. This one took place a couple months before the junior lien was originated. And what do you know? It's all ones. The remark is current. The last reported date matches the date that this credit report is from. It's a month behind, but we're looking at from July of 2020, and the last reported date was June of 2020. So we can see that it is active. Now, sometimes you'll see things like this. This hasn't been reported since 10/17. If this was our mortgage note reporting in 10/17, it's not active. That's not up-to-date information. So it's good to make sure that your reported date matches a month or so behind the date you pulled the report. And it's all ones for 24 months here. So that means it's been current for the last 2 years. That's great news. There is a balloon payment, but we can see they're making their payments here as expected. Now, this home equity line of credit, this is what we would be buying as a junior lien investor. You can see this has been charged off, it's past due. This is non-performing second behind a performing first. A very, very good situation for a note investor who's looking at this asset. You can see some other things as you scroll down, other trade lines, an Amex card, there's a luxury card, some BMW loans, an auto lease. So it's a good idea to go all the way through the credit report, but really the main thing you're looking for is the senior lien status. Now, this is where we would find the potential occupancy information. We could see what address the borrower is currently living in. And you can also, if you keep going, see potential bankruptcies and employment. Bankruptcies would be here under public records, and employment, we can see self-employed or she, and that could be a good thing, could be a bad thing, depending on the borrower's situation. But typically, this will give us a really great picture before we even go to the next step of the due diligence process. Looking at the credit report is the most important piece of data you can review as a junior lien investor. So let's look at another report from a different provider. Here's a TransUnion credit report. And this report, you can see it's a little bit more detail. It's not quite as text-based as the CoreLogic report, but I do believe that they're from the same source. If you looked at that CoreLogic report, and we'll look at one more, you see the remark is TUC for TransUnion Credit. So even though they look different, they come from the same bureau. So the TransUnion report I actually like a little bit better. For starters, they show you the current address right off the bat. I think that's very good to see in the beginning because you can compare that to the address up here that's redacted, which would be the address I put into the system to run this credit report. See if this address matches the current address so you can see if the borrower is residing in the property, if it's owner occupied. Employment details are here. We've got FICO, 610, a little lower than the last one. And then we get into the summary, as before, revolving installment. There's only one mortgage here. And we can get a quick snapshot that it's all fives. That's not good. But we don't normally use this report to check our senior lien status. We normally go right to the trade line. So let's scroll down. I think that's our boy. Yep, we lost our little puppy cam. Okay, so now we found the trade line. We can see it originated for $850,000 in June of 2005. It's paid down to $795,000, but they've got $91,000 of past due balance. And although this was verified 2/21, and the report came out on 2/21, so this is a new credit report, and it matches the reported date, which is good. The bad news is they've been delinquent all year. And last year they were current for most of the year, but they missed their final payments of the year and then have just been on a downward spiral since then. So as a junior lien investor looking at this credit report to get our senior lien status, not a great situation here. It's delinquent, so we want to add the balance to the past due amount to get the payoff balance. And that's going to be what we use to calculate our equity. The fair market value of the home minus these two added up, the senior payoff balance, equals the amount of equity that's protecting our second position mortgage note. So not a great situation here. We'll keep scrolling. We actually don't see the junior lien. In the beginning, we saw there's only one real estate account on this file. That's okay though. You don't always see every single trade line, especially if it's a charge-off loan that hasn't been active in a while. You would still see it in the public record though. So there is still a lien on this property, even if there isn't a trade line reflecting the junior lien. But since we know the senior is delinquent here, this is definitely going to affect our pricing of this loan, especially if we originally thought this was a current senior lien, and then you pull the credit and see this, you're going to definitely fade the pricing when you finalize your negotiations on a purchase like this. So let's look at one more credit report. We're going back to CoreLogic here, and this one is a rolling 30 example. So here's where I said, remember TUC, delivered by TUC. This report, it's also TransUnion. It just came out of the Credco Instant Merge credit report. So what we see here is there is one real estate account and it is 30 days late. So we can scroll through and skip some of this since we did already go over CoreLogic report. And then over here we see two loans actually, a home equity line and a regular real estate line, 1104. So that's senior versus 205. This came after. They're both reported the date the credit report came out, so that's good. But one is past due and charged off, non-performing, and the other is a whole bunch of twos. Remember that? Rolling 30. They've got a couple months where they miss and they're 60, but they catch up that late month and then they're back to rolling 30. So although they are delinquent, they're past due one payment of $3,250. They've been, actually the payment amount is only $1,946. So they're past due a little bit more than one payment here, but they're consistently past due. They're making those payments. So this loan we would price a lot higher than the last account that was delinquent, depending on the equity, but less high of a price than we allocate if this was current. If these were all ones here and they weren't having any struggles paying their first position mortgage, this second lien right here would be worth a whole lot more. If we keep scrolling just to go through the motions here, you can see the other accounts. You could see if there's, here's one that might be a medical debt, laboratory corporation. We can see some student loans. And then we've got at the very bottom, oh, they got a bunch of trade lines here. Finally, some identification information, address information, and employment information. Then finally, public record information where we would see the bankruptcy. So it's tough to show you that with things redacted because we do need to protect the confidential information here. But it's important to know where to find these information points. Addresses are really great because they give you that occupancy status. And although you're going to pull Pacer to review bankruptcy in more detail, you get a snapshot right on credit whether or not that borrower has filed for bankruptcy, which, by the way, a bankruptcy will most likely pause the collection reporting of the trade lines. So once a borrower has filed for bankruptcy, oftentimes you will not see current trade line reporting. Your reporting date will be back when the borrower filed the bankruptcy, and they've stopped reporting while the loan is in bankruptcy. So it's nice to see loans that aren't in bankruptcy because then we get a more up-to-date picture of the borrower's situation when we look at credit. All right, that was your crash course in credit reports. Please drop a comment if you have any questions at all. As we discussed, we were talking about pay strings, we were talking about balance, past due amounts, payment amounts, and reported dates. And then of course we had a couple of those tidbits, the other things you can gather from credit reports. So I hope that taught you a little bit more, especially as a junior lien investor, how to review credit for your senior lien statuses. So let's move on now to assets for sale. So I've got obviously some news from our previous offering. We showed you that in the pricing section of this call, but our next offering date is still to be determined. Most likely we're gonna see another offering in the second quarter of the year. So in any case, definitely get on our list at FIXnotes.com/buy, B-U-Y, or just go to FIXnotes homepage and then click Buy Notes. That will give you a little orange button to sign up for the non-disclosure agreement so that we can send you assets available when they become available in the future. Now, I will say, as a mastermind member, you will see more product for sale. Not only will you see more of my client's product, what we do for our mastermind members is we share loans that are actively within the collection process. So they could either buy loans that are currently in negotiation with a borrower, so you've got like a teed up workout ready to work on, or you can use that data as essentially a big case study to see the loans that have currently been active and see the statuses in the contacts with those borrowers. And then as well as our additional assets from my clients on the mastermind group, we also have an aggregated trade desk. And this essentially is a consolidation of all of the deals that I'm seeing on the marketplace. There's no fees or anything here. In fact, mastermind members can list products for sale on the aggregated trade desk with no fees either. So to buy and sell loans with no fees, become a mastermind member. We've already aggregated $1.1 billion worth of unpaid principal balance in the last 2 months alone. So there's a whole bunch of asset opportunities available just behind that mastermind membership. Open door for you to join. All right, so that's it for assets for sale. Let's get on to the case studies. Probably my most favorite time of the show. Case studies are where we can really put the rubber to the road and see how all of this information gets distilled into an actual deal. So we're talking first of all about a non-performing second mortgage secured by a condo. So this isn't a single family residential property. This is a condo in a building of other condos, which has some interesting implications. Typically, pricing is lower on condos versus single-family residential properties, but there also are some advantages to investing in a property like this with a shared roof. So this was a payoff of $65,000. So stay tuned and we'll learn how this came to be. It was a $250,000 value on this condo. The senior lien was $152,000, which left, oh, well, also there's a homeowners association. The condo association was past due $14,000. So that leaves equity of $83,251. Essentially, if you took the $250,000 home value, you paid off the senior at $150, you paid off the homeowners association at $14, you'd be left with that $83,251, securing your principal balance as a second lien holder of $73,207. So it looks like a full equity deal at first, which is good. But as you'll see, we didn't get a full payoff here because of some additional troubles here, some additional challenges. So we ask our borrowers three things. What happened? Where are you now? And what do you want to do? Those three answers give us enough information to start putting together a resolution for the borrower that fits everybody's goals. And in this business, we're looking for win-win-win. We're looking for wins with the banks that we buy loans from. We're helping the banks clear out their balance sheet. We're looking at wins for the borrowers because we're able to often offer them a discount, or at the very least offer them a seamless resolution process to help them get their loans paying again. And it's a win for us as investors because we buy these loans at a discount. So if we have these three answers from the borrower, we can do our best to ensure that triple win resolving the deal. So what happened in this case? The borrower was attempting to sell their primary residence. The senior lien holder and the homeowners association were not willing to accept the discount. The previous lender as well, who this loan was purchased from, was not interested in offering any discount. So the borrower's counsel said, well, you got to file for bankruptcy. And unfortunately, in this case, a bankruptcy would have really slowed down the process. Now, because we're a secured junior lien holder, we would not be stripped on this deal. It is possible for a bankruptcy to strip and wipe out a junior lien if it's not secured. They call that a wholly unsecured junior if there was no equity here. But because this has equity, we would be pretty safe in the event of a bankruptcy. We'd get paid eventually, but the bankruptcy court does take some time. But a lot of times you'll see borrowers counsel advising of bankruptcy, even if we're only a couple $1,000s off. Essentially, instead of paying your attorney, the borrower could negotiate with the lien holders, and especially in this case, because now an entrepreneurial company, my client, owned this loan versus the previous lender, the bank, who is not agreeable to a discount, we're able to make some things happen here. So where are they at now? If the junior lien holder was able to offer a discount, this borrower would be able to avoid a short sale. It's still a short sale from the junior's perspective, but if the senior does not have to approve a short sale, it really speeds things up. And they could also pay off their condo dues if we were able to offer discount. So we provided the contract and settlement statement. We got that information from the borrower so we could actually see on the settlement statement how much is being allocated to every counterparty in this sale. And that was good evidence for us of the situation, that even though it looked like we had full equity, there's not quite as much equity as we'd imagined, and a discount would really help things along. So we did negotiate a $65,000 discounted payoff to close this deal. The borrower saved a good amount of money and was able to avoid some of the logistics with these big bureaucratic institutions, the homeowners association and the senior lien lender in this case, who was not willing to accept a short sale. So we helped the borrower avoid bankruptcy. We got a great payoff on our loan, and everybody wins here. Now, a couple of additional things to comment on this one. First of all, we paid $32,200 for the non-performing loan. So we paid about 44% of the unpaid principal balance. We took about 3 months. It was a quick deal, and that's why we were able to offer such a discount, and only $425 of expenses to go through our due diligence, onboarding of the loan, and the collection process to get to a $65,000 payoff. A couple takeaways here for you. First of all, always review the settlement statement. The HUD-1, as it's called, is what tells you all of the counterparties involved in a sale and who's getting paid what. So if a borrower claims that a full payoff is not possible, you want them to verify that information by sending you the settlement statement. You might get that from the title company or from the realtor if there's a realtor involved. In this case, we were working with the borrower directly, so the borrower did send us the settlement statement to review. The borrower's counsel in this case was encouraging a bankruptcy. Like I said, it's in their best interest to file a bankruptcy because they get paid their fees to file. But in this case, negotiating the lien is a better outcome for everybody. The borrower isn't going to spend $2,000, $3,000, $4,000 on legal fees filing for bankruptcy, they're actually going to save money if they just do a little bit of legwork and give us a call, which they did, and they were proactive. Within 4 months of buying the loan, we were able to settle this deal, which gives us a very substantial internal rate of return, which we'll see soon. Condo homeowners association fees are often negotiable. If the numbers are tight, when you look at that HUD, the settlement statement, you could propose a discounted payoff to the homeowners association. In this case, it was not possible because the senior lien was getting a full payoff. The homeowners association would not budge on theirs either. And since this is, I think, in a homeowners association super lien state, we would have been in trouble if we pushed it. The homeowners association in super lien states actually has a priority lien position. So we would not have gone away in the green there if we would have fought that process. It could have ended up in the bankruptcy process where the homeowners association would have been priority over our junior lien. Not that it would have mattered to get our lien wiped because there was equity here, but it is certainly something to consider. And looking at the HUD, you can see things like the homeowners association fee, but you can also see the realtors fees. And a really great point of negotiation, if the numbers are tight, is to ask the realtors to taper down their commission a little bit. Because these realtors want to get the deal done. And if the lien holder is taking a huge discount on the amount that they're owed, and the realtors are getting their full commission, you can sometimes get those realtors to cut those fees in half to make sure that the lien holder not is made full entirely, but maybe gets to a higher percentage of the balance to make everybody happy. So definitely something to consider. Always review the HUD-1, the settlement statement, when you're looking at a sale like this, especially when it looks like it could be a short sale. All right, so this one, like I said, a huge internal rate of return of 407%. The reason it was so high is because we got an 89% unpaid principal balance payoff in 3 months, or did I say 4 months on this one? I think this was 3 months. And that really jacks up your internal rate of return when you're able to turn that money over very, very quickly. So if this had taken a full year, it would have been over 100% internal rate of return. We would have doubled our money, almost doubled our money. But because it was so quick, and you're able to redeploy this capital back into more note deals, you're able to compound and accelerate your income and your rate of return on this deal. So great internal rate of return. Previous episodes, you can learn how to do this calculation using XIRR in Excel. It's an Excel formula to track your internal rate of return using a cash flow and a string of dates. So that's what we use to estimate these internal rate of returns. And I'd encourage you to do the same on your note deals. All right, let's talk about another case study. This one is a loan sale, a reperforming loan sale to be exact. A loan that was purchased as a non-performer, then made to be modified and paying again, and then sold to a cash flow investor who's looking for income. It was sold for $40,982, secured by a single-family residential property, with a value of $566,400. There was a senior lien of $386,440, which gives us, is that math right? Yeah, it is. $179,960 of equity, protecting our $65,873 junior lien. So huge amount of equity coverage here. This is very well protected. And since it's cash flowing, this is a very, very safe monthly payment that you could be purchasing by buying this loan. So the three items that we cover when we talk about loan sales are whether it's a bulk or a retail sale, since this is a very important contributor of the pricing. Then we talk about the due diligence findings, and then a final purchase decision. So in this case, it was a bulk sale as part of a year-end closeout of 2020 legacy inventory. So there was a discount there. Some of the due diligence findings: senior lien is current, subject property is owner occupied. Great news. The modification agreement was completed with a $1,250 down payment. Also great news, the borrower put skin in the game right off the bat. $612 per month at an 8.75% interest rate. And it's been seasoned for 6 months. That means the borrower made their down payment and the last 6 payments successfully. And now we're ready to sell the loan at the highest possible amount in the earliest possible time. Now, I would say some loans can be sold with less seasoning, but once you get to 6 months of seasoning, your market opens up dramatically as far as the investors who'd be willing to purchase that loan. In this case, the investor that we sold it to, since it was a bulk buyer, they would have bought the loan with less seasoning. So it wasn't as much of a consideration here. And this loan would have been worth a lot more should we have sold it retail. Now, we'll get to that in a minute here. There was some medical debt on the credit card, but it had been paid off, which was good news. So this one, we agreed to purchase We agreed to sell the loan. They agreed to purchase the loan for $40,982 as part of a re-performing loan package. So let's talk about a couple considerations here. Right off the bat, this was a stronger buyer discount because of that bulk acquisition. That definitely helped their pricing. The property is in New York City. So that means it's a long foreclosure state, a judicial state, where if the foreclosure was necessary, it would have taken a very, very long time. So that definitely affected the price on the downside. And as a one-off sale to a retail investor, or perhaps someone who holds loans in their self-directed IRA, a 13 to 16% cash on cash return would have been a fair price, which values this loan maybe $44,000 to $55,000. So they got quite a great deal on this because it was a fire sale in bulk at the end of the year, whereas we could have sold this for more should it have been sold to a one-off retail type of investor. So we got 62% of the unpaid principal balance, offers the investor a 17.5% cash on cash return, secured by real estate with plenty of equity on an owner-occupied property behind a senior that is current. That's a very, very good deal for the buyer in this case. So this is a good example to show you how a reperforming loan that you maybe purchased as a non-performer can then become a cash flowing loan that is eventually sold on the secondary market. So then you can buy more non-performing loans, help more borrowers get paying again, and then sell those loans on to other investors. So that's it for the show today. Thank you so much for sticking around. Since you made it this far, I definitely want to offer you a free 15-minute consultation. I offer this to any new client of mine. We can get on a call, discuss your goals, see how we can work together. That's 100% free. I would encourage you to subscribe to this channel, like this video, leave a comment, please. I don't get a lot of comments, but I'm always answering the ones that I do get. So it's an easy way for some free advice. Drop a comment on any of my videos and I will get to it as soon as possible. If you want to book the 15-minute consultation, go to robbiemax.youcanbook.me. You'll see my calendar. You can pick a time. Be happy to get on a call with you there. So let's just go over the upcoming schedule real quick here. We've got our next mastermind call coming up, as I mentioned, on the 3rd of March. It's the first Wednesday of the month. March 3rd, 2021, our next mastermind call. And then the final Wednesdays of the month are the next Be the Bank show. So March 31st, we'll be talking on the YouTube channel again with our next episode. So the final call to action here is if you would like to join the mastermind group, I would highly, highly encourage that you do so. The value proposition here is huge and the price is only going up. You'll be given access to our private Podio workspace where we have events, a database of vendors, forums to communicate with the other members and myself, case studies. All the case studies we do on the show are detailed in more detail on the Podio workspace. We've got a county and state level database. These are huge. Every county in the country, every state in the country with details on foreclosure expenses, potential REO expenses, whether or not it's a judicial, non-judicial state. Specifically the counties, you can type in any zip code in our search box and you can see what county that property's in with links to the county website and some other details on how to record assignments there. It's constantly growing. We're adding more content to these counties. And then we've got inventory, which is reflecting all of the case studies. So you can see the actual inventory details and you can use this inventory app as a template to build your own inventory app in your Podio workspace. Then document templates, exactly what it sounds like, modification agreements, assignments, satisfactions, other types of documents that you can use in your business. And then finally, like I mentioned earlier in the call, the aggregated trade desk where we posted over $1 billion of unpaid principal balance of mortgage note opportunities already this year. So you get access to the private Podio workspace, you get 50% off my consulting rates, you get monthly member Zoom calls, and I didn't mention this earlier as well, the aggregated trade desk is a place where you can list assets for sale as well for no expense. So no reason why you shouldn't join this. The price is going up. It's $60 per month now. I think we only have 4 spots available at $60 per month. And every 10 users, every 10 members that we get, we're increasing the price by $10. And I was originally going to cap that at 80, but I think we're going to just indefinitely push it up. I've been consulting with some other mastermind companies that offer masterminds, and they said my product here is like criminally underpriced, and most masterminds are like $500 to $1,000 per month. So eventually, when we've got 900 members, we'll be at $900 a month. And I will say right now, this group will be limited to 1,000. We'll never go over 1,000 members. There's 1,000 seats for the group. And once it's filled up, That's it. We will not be enrolling any more mastermind members until a seat opens. And by the way, if you get in at $60 per month and you leave, if you want to come back and there is a seat available, it'll be at the higher rate. So definitely consider that. Only three more slots available at $60 per month. Then we're going up to $70 and increasing the price for $10. Go to FIXnotes.com/MNM for more information and to sign up. Permanently increasing with each 10 members. So I'd highly recommend you do so sooner than later. And by the way, I just started an affiliate program for mastermind members. So you can actually make your money back just by referring others to the group. And it's a no-brainer right now at the price that it is. So definitely check that out. You'll be given access to podio.com/FIXnotes/mastermind. So once you sign up here, you'll go to this link and get all of the goodies that we have to offer. Whew, all right, that is it. Thank you so much, everyone, for watching. This was a fun show because I've got some new gear here. I'll actually give you a little sneak peek at the desk. So we've got a new mixer for audio. Hopefully the audio sounds better than before. We've got our video switcher over here, and hopefully going to continue to add value, continue to improve the show. We're always looking to reinvest to make this as best of a resource to you and other note investors as possible. So thank you so much for joining us. We've got a sleepy little puppy here. He'll come out and say goodbye to end the show here. Hey, dude. Oh, come on, my friend. Right here. Right here, guy. All right, he wants to stay in his cage, so I'm gonna bring him right up here so you can see him. Say goodbye, David Rose. All right, everybody. Thank you so much for joining. We'll be back on March 31st with our next episode of Be the Bank. In the meantime, find me in the YouTube comments. Check out the website for more free content. And I wish you the best of luck on your own note investing journey. Until next time, I'm Robert Haitha.